Pooled investments are investments in securities issued by entities that represent ownership in the underlying assets held by those entities. So, let's first understand before discussing the types of it, what pooled investments would constitute. So, think of it, there could be individuals, okay, who in their personal capacity would have certain amount of money. Now, this money is being entrusted with an entity, okay, and this entity in turn uh, goes about investing the money into equities or fixed income or alternative investments. All right, so here you have individuals who would be putting in their money with an entity which in turn would make the investment. Now, this entity in turn would issue securities. So, while they would put money, they in turn would get securities or units. All right. So, these security or units would represent the ownership on the underlying assets. So, this is how the entire structure gets built around. Now, depending upon the ticket size of the investment and the mandate which this entity has, it could either be, these pooled investments could either be mutual funds or exchange traded funds, in which basically the investors can participate with a relatively small initial investment. So they'll have to park or put in a small amount of money. Or else it could be hedge funds and private equity funds, in which case the minimum investment could be something like US dollar 1 million. All right, so there the ticket size is going to be much greater. All right, so let's look at mutual funds. Mutual funds pool money from several investors and invest these funds in a portfolio of securities. Individuals and institutions invest in mutual funds to obtain diversification benefits and to avail the investment management services of qualified managers. Each investor rather has pro rata share in the income and the value of the fund. So this I think is quite well understood. The value of a mutual fund is referred to as the net asset value, which is calculated on a daily basis based on the closing price of the underlying securities. All right. So if I would have put in money into a mutual fund, which in turn goes about investing into various, let's say, equity stocks, and the value of my 1 unit, okay, so in case if I would have bought 1 unit from mutual fund, the value of that 1 unit would depend upon the value of the underlying securities which this mutual fund has in turn invested into. Okay, so just to take a simple example, let's say here you have the balance sheet of a mutual fund, and like me there are 99 other investors, and each of these investors had bought 1 unit, so altogether there are 100 units, all right, which this mutual fund had issued. And when it was issued at $10 each. So the mutual fund has $1,000 with itself, and these $1,000 fund, or rather this $1,000 fund, was basically invested into various equity stocks. So right now the value of those investments accumulate to around $2,000. All right, so the $1,000 has, the value has grown to $2,000 over time. So in line with that, every unit of mutual fund now would be valued at $20. So that qualifies as the NAV. Okay, so the value of mutual fund is referred to as NAV, which is calculated on a daily basis based on the closing price of the underlying security. So the assets that a mutual fund has, you look at the current value of it, you divide it by the total number of outstanding units to get a sense of what the NAV per unit is. Now, there are two types of mutual funds. One, the open ended. Now, this is quite important, guys. The open ended fund. And the open ended fund would accept new investment funds and would issue new shares at a value equal to the fund's net asset value per share at the time of investment. These funds also allow investors to redeem their investment in the fund at the prevailing net asset value per share. So an open-ended fund is more like a current fund. So it operates all the time. So let's say if I were to go back to my example, there were 100 units which were issued by the mutual fund and to begin with, and the corpus that it had invested into has in value terms grown to $2,000, making the NAV per unit at $20. So if a new investor comes in and would want to buy the unit of this mutual fund is going to issue another one unit. So the total outstanding units would become 101. And in turn, the investor would give $20 to the fund. So you would have $20 cash out here. Now, this $20 cash is very likely going to be deployed by the mutual fund into stocks. Okay, so similarly, if somebody were to withdraw and redeem his unit, the investor, he might as well deposit or surrender the unit to the mutual fund, and the mutual fund in turn is going to redeem it to the investor. So in case if they have cash in the balance sheet, that would be used to redeem the units, or else they would sell some stocks to finally have some cash in place. Okay, so it's more like a current fund where new units could be issued and the existing units could as well be retired. So to that extent, very appropriately termed as open-end funds. Now, unlike an open-end fund, a closed-ended fund or closed-end funds accept no new investment money into the fund. So if I were to go back to my example, 100 units was what was issued to begin with, and the outstanding number of units continue to stay at 100 units. So if somebody were to sell off their units, they need to sell it on the exchange, they need to sell it in the open market. There's no scope of redeeming it with the mutual fund house. So shares in the funds are traded in the secondary market. So new investors invest in the funds by purchasing shares in the market, and investors liquidate their holdings by selling the shares in the market. So these shares are essentially units of these mutual funds, which are bought and sold in the secondary market like any other common stock. Now, unlike open-end funds, shares of closed-end funds can trade at a discount or premium to the net asset value per share, depending upon the demand and supply of these shares in the market. Now, given that it will be difficult to pull off an arbitrage act out here, so there is a possibility that these units could trade at a discount or at a premium to the NAV of these units, and it would be very difficult for somebody to close in by way of an arbitrage. Unlike an open-end fund where basically the units are surrendered and the fund has the obligation, the responsibility to redeem money to the investor to the extent of the NAV, which is not possible in the case of closed-ended funds. All right. So the structure of open-end funds makes it easy for them to grow in size given the current nature of it, but it does pose the following problems. The portfolio manager needs to manage cash inflows and outflows. An inflow of new investment requires the manager to find new investments. It's rather an inflow of new investment money requires the manager to find new investments, and funds need to keep some cash for redemptions. Okay, so this I think should fall absolutely in line with what I discussed about open-end funds. The closed-end funds do not face these problems, but as mentioned earlier, they cannot accept new investments. So there's no scope of growing the size of closed-ended funds. Now, the other way of categorizing mutual funds would be in terms of load funds, which are essentially a percentage fee that is charged for investing in the fund at the time of investment or at the time of redemption. So basically, a certain percentage fee, let's say an entry load or an exit load, is charged depending on when it gets charged. So if there's some fee which gets charged at the time of investment or some fee which is charged from the investor at the time of redemption, that is what would make it a load fund. A no load fund would not really have these entry or exit loads, but would essentially have an annual fee which is basically the asset management fee, which would be calculated based on some percentage of the fund's NAV. So we've already looked at the classification of mutual fund in terms of open-ended, close-ended, or let's say in terms of no load or load. The other way of classifying the mutual funds would be in terms of the characteristic of the investments that they carry the mandate for. So in case if it's a money market fund, these mutual funds would essentially be investing into money market instruments, which are high quality short term debt instruments. So, money market mutual funds could either be tax free or taxable funds. Come over to the bond funds. These invest in individual bonds and sometimes preference shares as well. Unlike money market mutual funds, these instruments would have a longer maturity. Come over to stock funds, equity funds. These invest into equities and equity indices. Stock mutual funds can be actively or passively managed. Now, this is important, guys. You need to know what we understand by active management and passive management. So, let's understand that. An active portfolio management aims to outperform a benchmark portfolio or index by tilting the individual weights of stocks in the portfolio away from their weights in the benchmark. Okay, so clearly there will be much greater discretion on the part of the investment manager to decide on the weights that he would have into these individual stocks, and the weightages could very well be very different from the kind of the weightage that these stocks have in the benchmark index. Okay, so on the other hand, a passive management, which is essentially indexing, so they would basically replicate the index, would aim to track the performance of the benchmark portfolio by attaching the same weights to individual stocks as prescribed by the benchmark. So in the case of passive investing, there would be very little intervention on the part of investment manager, and largely his role is limited to replicating the portfolio with the benchmark index. While in the case of active portfolio management, there would be discretion on the part of the investment manager to have stocks uh, being bought in quantity which could very well indicate a weight different from what it has in the index. Also, active management could also involve taking in stocks in the portfolio which might not be part of the index. So, active management entails higher management fees because the fund manager will have a far greater role to play so as to compensate him for the research conducted to select mispriced securities. So clearly, an active investment manager thinks that there are pockets of opportunities, there are pockets of undervaluation which could be exploited upon. Further, it results in a high turnover of portfolio securities because there would be regular buying and selling, which in turn would lead to greater capital gains, tax liabilities, and transaction costs relative to index funds. So this is something that would be there in active management, but on the other side, one would also expect a greater return as far as an actively managed portfolio is concerned. Come over to another type of mutual fund, which is hybrid or balanced funds. Now, these funds would be a combination of stock and bond funds, so they would invest in both bonds and equities. Okay, so let's discuss ETF or exchange traded funds. Now, that's again very important. Exchange traded funds issue shares in a portfolio of securities and are designed to track the performance of a specified index. Now, to that extent, it looks like a mutual fund, and that too a passively managed fund. An ETF purchases a large number of shares in the same proportion as the index it tracks and issues shares in the ETF to investors who want to track the same index. ETFs combine features of closed-end and open-end mutual funds. They are similar to closed-end funds in that they are traded in the secondary market. However, like open-ended funds, their price stay close to the NAV per share. Now, that might get you thinking that in case if like close-ended funds, they are being traded in the secondary market, how are they different from the close-ended fund, and what makes it possible for the ETF to trade very, very close to their NAV, unlike what could happen in a close-ended mutual fund? Now, ETFs differ from index mutual funds in the following ways. Okay, and I think this part is very important. You should know the difference between ETF and mutual funds. Investors in index mutual funds purchase shares directly from the fund, while investors in an ETF purchase shares from other investors. So that's more like a close-ended fund. Investors are allowed to short ETF shares and even purchase them on margin. So this is almost like shares or stocks which are traded in the market. So one can go long, one can go short, one can even purchase them on margins. So ETFs have lower costs, but unlike index mutual funds, investors do incur brokerage cost while trading ETFs, but that's applicable for stocks as well. ETFs are constantly traded throughout the business day. Each trade occurs at the prevailing market price at that time. All purchases and redemptions for a mutual fund for a given day occur at the end of the trading day at the same price. Now, this is of course true for open-ended mutual fund, but unlike the open-ended mutual fund, the ETFs are traded on the exchange all throughout the market hours. ETFs pays out dividends while index mutual funds usually reinvest dividends, but not necessarily so. Sometimes they as well pay out dividends. The minimum required investment is usually smaller for an ETF. ETFs are generally considered to have a tax advantage over index mutual funds. So these are more of facts than anything else, which you should keep in mind. But we realize that there are more differences between ETFs and open-ended mutual funds simply because ETFs, like close-ended funds, are traded on the exchange. But we need to keep in mind that unlike close-ended funds where the units could trade at a premium or discount, ETFs trade very much in line with their NAV. What makes it possible? Let's see that. Okay. Before I move on to the next slide, just a point which I was about to make. Uh, Given that the investors in ETF have the scope of surrendering their ETF units and getting the underlying assets in return, so that really creates an arbitrage opportunity in case if the ETF were to trade at a discount. And this facility itself ensures that the ETF would trade in line with their NAV, unlike a closed-end mutual fund. Let's move on and look at separately managed funds. A separately managed account, also called a managed account, wrap account, or individually managed account, is a fund management service for wealthy investors. The portfolio manager manages the account exclusively for the benefit of the client and aims to meet the needs of the client in relation to investment objectives, risk tolerance, and tax situation. The client may also receive personalized investment advice in return for an annual fee. So the concept is quite simple. Unlike somebody who would be investing into a mutual fund because of the limited ticket size, if you have an individual who has a large corpus at his or her disposal, that would give the concerned investor, let's say, uh, the privilege, or let's say, create an opportunity to appoint a dedicated portfolio manager. So this portfolio manager would, in a customized capacity, manage the funds for the concerned individual. So how would the separately managed account differ from mutual fund? So let's see that. Unlike investors in mutual funds, investors in SMAs directly own the shares and therefore have control over which assets are bought and sold and over the timing of transactions. Because here you have an individual who appoints a portfolio manager who in turn goes about creating the portfolio for the investor. So here the investor will have a direct ownership over the assets which are being bought by the portfolio manager. Unlike a mutual fund in which no consideration is given to the tax position of the investor, transactions in SMAs take into account the specific tax needs of the investor. Now, please keep in mind that in the case of mutual funds, you have a multitude of investors who in turn would have put their money into the mutual fund. So, the mutual fund doesn't really necessarily go about looking at the tax uh, profile and the tax needs of the different investors and then try to customize their investment strategy, their trading strategy around the tax profile of the investors. But that's very much possible in the case of SMA because here you have a dedicated portfolio manager managing your portfolio. So the required minimum investment for an SMA is usually going to be higher and much higher than for a mutual fund. Let's look at hedge funds. Hedge funds have evolved to encompass a host of funds that simply look to generate absolute returns for investors as compared to other funds that define a specific benchmark whose return they try to match or exceed. So, unlike the mutual funds or ETFs, which essentially are built around indexing, or even actively managed mutual funds, which would have some kind of a benchmark index to be outperformed, hedge funds are built around strategies and they in turn would have absolute return objectives in mind. Now, hedge funds differ from mutual funds in that most hedge funds are exempt from many of the reporting requirements for which are applicable for a typical public investment company. So, the regulatory requirements are much lower for hedge funds. They require a minimum investment that is typically 250,000 US dollars for new funds and 1 million US dollar or more for well established funds. So the ticket size is much larger. They usually place restrictions on investors' ability to make withdrawals from the fund. So generally, the informal or formal lock-in period is quite significant because a lot of money is in turn invested into illiquid assets or assets which would take a while to show up value, or even it could be locked into strategies which would take a while to show up value. So the total management fee also happens to be much larger because it will have, apart from the management fee, there would be a performance based component as well, which is going to be quite significant. So unlike a mutual fund where essentially you will have asset management fee and sometimes load entry load or exit load, in the case of hedge funds there will be a big portion which would be uh, incentive fee and which would be linked to the performance of the fund. So what are the strategies around which hedge funds are built? Now, hedge fund strategies may involve significant risk due to the use of leverage and derivatives. Now, some of these are convertible arbitrage funds, where securities such as convertible bonds are purchased and simultaneously the fund takes a short position in related equity securities. So basically, trying to create an arbitrage between the value of convertible bond and the value of equity stock. Implied out here is that convertible bonds are could be undervalued vis-a-vis the price of the stock vis-a-vis the equity stocks, and hence one could take a long position in convertible bonds and short position in the concerned equity stock. Dedicated short bias funds, they take more short position than long position. You might have a hedge fund which is built around the emerging market theme. They would invest in companies and emerging markets by purchasing corporate or sovereign securities. You might have an equity market neutral fund which would have long and short positions almost in equal weight so as to bring down the beta to almost zero, and basically the long positions would get created in undervalued stock and the short position would get created into overvalued stocks. event driven funds, which would look to take advantage of specific company events such as mergers and acquisitions, restructuring, sometimes a likelihood of bankruptcy, and so on and so forth. So, in those kind of events, the fund would take the relevant position to create some uh, big absolute returns. Fixed income arbitrage funds, they take opposing positions in debt securities to profit from arbitrage opportunity and to limit interest rate risk. So the idea is to create a low duration portfolio by taking long and short position into debt securities, and so largely the money would be made out of the the changing spread on the bonds in which they had taken position. Global macro funds, they attempt to profit from changes in the overall macroeconomic environment using derivatives on currencies and interest rates. Long short funds, they would tend to go long on securities that are expected to increase in value and short securities that are expected to decrease in values. Now, this sounds very much like a an equity market neutral fund, but what makes it different is that they attempt to profit from movements in the broader market as well as from identifying overvalued or undervalued securities. So, out here, these funds would tend to have a net long position or net short position in terms of the movements of the market, apart from the reason being that some stocks are undervalued or some stocks are overvalued. So kindly keep in mind that these funds would tend to take long short positions or combination of it, driven by the general movement that prevails in the market, apart from stocks which are being fundamentally identified as overvalued or undervalued. Let's look at another category, which is buyout and venture capital funds, or other categories. So, the leverage buyout, LBOs as they are popularly known as, the LBO funds raise money specifically for the purpose of buying public companies, taking them private, and restructuring them to make them more efficient and profitable concerns. So, one would clearly understand that these public companies could be at stress, they would be takeover targets, and the LBO funds would take over such companies, get them private, and then restructure them into more efficient and profitable companies. The purchase of company shares is usually financed with a significant amount of debt. So that's where the term leverage comes in from. The idea is to service the debt by increasing the company's cash flow and then to exit the investment through an IPO or sale to another company. All right, so this is important. A venture capital fund does not buy out a company but provides financing to startups. So, a buyout and VC funds would have the following characteristics. They take equity positions in companies and play a very active role in managing these companies. Although keep in mind that buyouts are generally focused on those companies which are quite mature but would have fallen into onto bad times or into bad management, and hence the idea is uh, to get them out of trouble, restructure them, make them profitable. While VC funds would tend to invest into young companies. Okay, but at the same time, they would also look to help companies become bigger and larger in size and profits. So, be it buyouts or VC funds, they invariably play a very active role in managing these companies. The eventual exit strategy would be an important consideration for both, because the buyout companies, while LBOs would tend to buy out public companies, they generally take them private. Okay, and VC funds would invariably invest into companies which are young and private. Okay, so clearly the exit strategy for both of them would be an important consideration. and more often than not, they try to exit at the time of IPOs. LBOs and VC funds are similar to hedge funds in that they have relatively high minimum investment requirement. Investors are unable to withdraw money from these funds for a specified period because one would appreciate that the gestation, be it in the companies where the LBOs would have invested or the young companies where the venture capital would have invested, the gestation period is going to be pretty much significant. So, to that extent, the investors would have to wait for a while. And when we say investors, we are essentially talking about investors who would have funded these LBOs or VCs. They would have to wait for a while to see their money grow, to see the value of their investment grow before start withdrawing their funds. And hence, also remember that the returns, since the returns are going to be quite high and largely on account of the decisions which are being taken by the managers who are at the helm of LBOs or venture capital, the management fee is going to have a significant performance based component. So that again makes it very, very similar to hedge fund. So there we come to the end of this chapter. Thank you.